Before we get back into fundamental analysis, I think it's important to point out that in this DVD, our objective is to give you a top-level overview of the various aspects of stock analysis. In the next DVD, we will be getting into more and more detail, but I think it's important to have a fundamental, basic understanding at a 90,000 foot level of what the two different analyses are. Now, we covered that in a second. So let's get back to fundamental analysis. It delves into three financial reports as a part of the analysis: the cash flow, the balance sheet, and the income statement. Now, I don't know about you, but when I was in business school, I found accounting incredibly boring. It drove me insane. I failed it once, and I barely made it through the second time. I was a marketing sales guy. Matter of fact, the joke of the day was, did you hear about the constipated accountant? He worked it out with a pencil. Anyway, but it's still important to know, and it's really not that complicated. Let's look at the balance sheet, okay? What does a balance sheet do? Well, real simple. The word balance means it has to balance. A balance sheet is basically assets equals liabilities plus equity. Or another way to write it, which is the one I like, is assets minus liabilities equals equity. But for the sake of a completed balance sheet, this is the formula they use. But in trying to understand what the hell it is, this is the best one. Assets minus liabilities equals equity. Now, let me put it in some simplistic forms. What is this used for? The balance sheet is a snapshot in a point in time. It just captures everything in one shot. It's just like a photograph explaining what is this company worth. That's what it tells. Now let's take an example that most of us can understand. Let's assume that we own a house. The house right now on the open market is worth $150,000. I have a mortgage on it at this time, a liability because I owe money on it, for $50,000. My equity on the house, $100,000. If I sold the house, I would have to pay off the mortgage and I'd have $100,000 left over. Now let's expand that a little bit and say, let's look at other things. Let's look at, okay, what about the furniture in the house? Is the furniture paid for? Do you have loans on the furniture? Let's look at, do you have any inventory, tools in the garage if you were to sell the whole thing? Do you have a car? Is the car paid for? That's what a balance sheet looks like for a company. It looks at assets minus liabilities equal equity. So it's a snapshot in time to understand what the company's worth. We're going to get into detail, but basically use common sense when you think about what are assets and what are liabilities. What's cash? Cash is an asset. A loan, it's a liability. Accounts payable, money you owe, that's a liability. Accounts receivable, you've sold goods and people haven't paid you yet because it's net 30 and the 30 days are not up yet. But it's on the books as accounts receivable. That's an asset, all right? So in closing, a balance sheet is a snapshot in time that basically tells you what is the net value of this company. Take all the assets, take all the liabilities, and what's left over is what the shareholders own in the company.